Drew, Meredith, how you doing?
Great. Good to get a little break from painting the roof.
Yeah, mate,
Big day today.
yeah, you're almost a bit like a bit of a jailbird look going on there. You got the shape, you got the shaved head, you've got paint all over yourself, you've got a beard, and you're in a black t-shirt.
I believe they call it it's a fresh fade.
That's
apparently.
a fade.
Yeah, when you don't have a lot of hair, you have to do different levels of shaving, as you'd be well aware.
Yes.
And they fade it in to make it look like you got more on top.
Fascinating stuff there. That looks great. Yeah, well done. And what have you been up to other than getting paint on your hands?
Just trying to get on top of what Donald Trump is making policy on Twitter. I think that's a big part of it. And at the same time, we've got a random earnings season coming through in the US. But there's no shortage of stuff happening at the moment.
Yeah. How are Waffle clients reacting to it all?
I think we've just pushed out our latest round of quarterly reviews, and we got a lot of questions about whether they should be buying into this market. I don't think we got a single should we sell of the kind of 200 clients we work with. But there were many buys or should we buy or what would we buy, but no one overly aggressive or excited to be going into market. I think, and that's kind of cognizant of how quickly it turned around. You know, you put 100 grand in on the bottom day and made a good early profit, but it turned around so quickly. And now the uncertainty is kind of growing, but the volatility is you could say disappearing, but it's been on the upside in the last few weeks. Like markets have just recovered in the last, I think, 3 days in a row.
Yeah, well, that's because who would have thought that maybe those huge tariffs on Chinese imports was not going to last? That's the rumor circulating in the New York Times this morning as we record on Thursday, the 24th of April, Drew. That maybe...
Who'd have thunk it?
Who would have thunk it? That maybe that's not a good idea, and maybe it was brinksmanship, but it looks like potentially the tariff will recede to a fair 50 to 60% is the current estimate. So in other words, as they would say in political circles, it looks like Trump blinked. So, yeah, what do you make of that?
Or it was he was hoping for less than that, or he was expecting less than that. He went from 0 to 50%, and maybe he had to go to 245 like he proposed to get to that 50%.
That's what he wanted all along.
I mean, it's like we have a really short memory. I mean, it's not that short, maybe 3 years, but like every policy decision and every announcement Trump made in his first term was via Twitter. And it's like we've forgotten about that. And the markets are reacting to a single tweet or an X, whatever you call it now, from Trump. So it was, I think, what was the first one? I want to sack Jerome Powell, which if we had remembered from last time, I think he actually said the same thing last time.
Yeah.
But he was the one who put Jerome Powell in, which was, and then Biden confirmed him in Biden's term. So it was more like, I think we forget that Twitter is like Donald Trump's consciousness, and it just comes out whatever he thinks at any given time. And then all of a sudden, can he actually quit it? Can he actually fire him? I actually got more questions about that than selling shares at the moment. Can he actually fire Jerome Powell? I'm like, he can. I'm sure he can. I don't know about the Constitution, but he's already changed his mind, according to Twitter. So the market tanks for a day. Jerome Powell's still got a job. I think we just forget how he just says everything he thinks before actually executing a policy on the other side.
I think it's a bit of a PR blitz, right? He has to retreat back from tariffs. Because interest rates haven't been cut. Bloody Jerome, ruining the policy. So obviously he's a very easy scapegoat for any negative news. Like Trump's not going to wear that politically. So that's really interesting. And, he did that in the first term as well. Like he was basically trying to argue with the central banks and tell them how they're wrong. Because as everyone knows, falling interest rates are good for politicians because it's like, look at this, cost of living pressures, look how much easier it is for you now, so on and so forth. Businesses can borrow more and spend. We're stimulating the economy and so on and so forth. And they just keep going on this merry-go-round. And at the end of the day, in modern democracies, there is a separation between the church and state insofar as there's a separation between the the fiscal policy and the monetary policy between the government and the central banks who maintain the economy and
Is there, though?
the market system. Well, that's what we're supposed to think. But really, who's in charge? The president or the Federal Reserve chairman?
The president.
The president. So, yeah, it's a bit different here in Australia because a lot of our pollies are pretty much toothless dogs. So there's basically no...
Have a whack before the election. Come on.
Well, yeah. Who are you voting for, by the way? Am I allowed to ask that on live TV? Probably not, because you're probably
I watch no mainstream news. I think the only news I get is from like Instagram, like some of those pages bring stuff up, and most of that's global, not Australian. I probably shouldn't say that. And the Financial Review. And it's like, I mean, I've traditionally leaned right. I did vote a different color last time. My dad will disown me if I say it again. I said that at my 40th birthday speech. You probably remember. A different color. But I'm probably undecided. Like, I don't even want to vote this time. I used to love it. I used to be so like, they're so bad. And now it's like, there's so little good policy. There's nothing to vote for.
Yeah.
Like, yeah, Medicare, great. But they're both doing that. Yeah, PBS, great. They don't benefit me, but they're great. It's like, and they're so similar, and it just doesn't. I don't know. It just doesn't make sense. Maybe if we had a president, it would be different.
Yeah, and that's the thing.
Not a republic. Not say we need a republic.
Drew pro republic. You heard it here first. He's going to be wearing a bandana in no time. The thing is that the U.S. Economic situation, China economic situation, whatever you want to call it, has totally overshadowed any Australian political commentary because, realistically, neither party has anything worth saying. And second of all, we've kind of just got to this point where people don't watch a lot of mainstream news anymore.
Are we too young to be saying how bad politics is?
Yeah. We just got a glass of sherry and we're just, commenting on politics. But basically, like, I actually think that I think there's kind of this structural thematic that's happened over the past 10 years. If you look at all of the big debates in the United States, where all of the traction was on social media and on podcasts.
Yeah.
It's been known for over 5 years that YouTube has more monthly viewers in the United States than all of cable television put together. That's not like me making that up. That's been the same thing for years. And here in Australia, YouTube is a way, way, way more powerful medium for communicating your messages to the Australian public than traditional broadcasts like Sky News and blah, blah, blah. No one cares. So I think the Australian pollies have completely missed that. They tried to do podcasts. They tried to do certain things in social media this year. It hasn't really worked. Meanwhile, the whole population's moved away from those traditional forms of media. So the messaging just hasn't got through. That's my 2 cents on the situation. And no, we did not have Albanese try and get on the Australian Investors podcast, if that's what you're trying to ask. He probably did. He probably just got
independence.
Put through to this. Probably just got caught up in a spam folder or something.
And Hamish Douglas is back. Did you see that?
There is, there is other news. The great man himself. There's a leader we can get behind, Drew.
I don't know what he's back doing. I was just perusing the Financial Review this morning. And Hamish Douglas, so the founder of Magellan, disappeared from the media, the funds management system. I can't remember how long ago, 2 or 3 years ago. We're still in that competition about that stock too. I'm sure he's got a dog in that race, horse in that race. I'm not sure which saying he used, but he was quoted in the Financial Review today with a few other fund managers. So it's always surprising what pops up, isn't it? Yeah, the Trump administration's policies will lead the US into a technical recession, but urge investors to continue to back the world's biggest economy for its long-term potential.
This is the thing. This is a quote in the AFR. Where is he actually? Like, why?
I don't know. So I didn't say I said the former founder, or the founder of Magellan, but not his current role or anything. So maybe I don't think he's spoken publicly in like 2 years. Yeah,
well, it's he's good. Obviously, Hamish has always had great insights for the Australian investors, to be honest. So it's good to see that he's come back and or maybe, I don't know, but it's good to see that. And he was also he's also pretty heavily involved in Barrenjoey, which is one of the investment businesses that Magellan seeded, which is a great investment, by the way. Same with Guzman and FinClear. Like Mitch and I spoke about that this week. They're all really good businesses that are a legacy of Douglas's management. So it'll be interesting to see what happens next. But do you think Australia will go into a recession, Drew?
I think it's too soon to talk, too soon to call. I should be good at these big macro calls, but we know.
You'd think by now.
Andrew Demuth would say technical. I mean, we've been in a per capita recession, as we get told every year, for like the last 10 years, because we're growing mainly because immigration is so high. You have more people, you need more stuff. I can't see, I don't think we have a massive exports to the US. And if this, like, the big deal is with China, and if that goes down and it isn't anywhere near as aggressive and bad as it was, and it may be back to boom times for Australia.
Yeah, maybe.
I wouldn't surprise me. And then there's going to be other homes for us for Chinese and other products. So I was talking to a client, part of an ASX listed business or a large global business, who said basically all this is just setting Europe up for a good period in the next kind of 5 years.
Yeah, that's fair.
All the tensions everywhere else.
Yeah, it's interesting, isn't it? Do you invest much in Europe?
We have a little bit. We've used, and I think it's so imperfect over there, as same as anywhere else. But like, you can access an iShares or I think the FTSE Europe or something exposure, but it's so concentrated, like everything else. It's got pharmaceuticals, got gas, like just. But we have had a satellite exposure to Europe outside of the normal core MSCI world benchmark as well. It's hard to read. I think where most the good exposures have come from for us in the past have been through active managers and a lot in the mid and small cap, because it's under research in a lot of these smaller European countries. True.
Otherwise, there was information here from International Business Machines Corp. Offered a solid sales outlook despite worries about the impact of a global trade war on the economy and tech spending. But its shares still fell in after-hours trade. Oh, there you go. That's a shame.
Yep. IBM's back. Bad signs for GYG. Chipotle Mexican Grill had strong first quarter sales, up 6.4%, but same store sales dropped 0.4%. So Chipotle, I'm saying it completely wrong. Chipotle, I think it is.
Yes.
You don't pronounce it t.
Okay.
But it's like a fresh Mexican grill in a similar way that GYG is. Not saying it's a bad sign. I'm just saying it seems like consumer spending is perhaps slowing a little bit, or was slowing ahead of the tariff announcements, and a bit of uncertainty.
ServiceNow came out with some really interesting results. So ServiceNow is it's a really interesting technology company. It's kind of like IT services meets CRM meets everything. And I think they have on their website, I was looking at it this week, actually, now stock. The business is up 6%, was up 6% today in the US, so Wednesday, but 10% after hours. So ServiceNow is a really interesting business. It's a SaaS company effectively, but with a twist. It's kind of got one of those big...
It's like automation.
It does automation, CRM, software. Just think everything for large businesses. A lot of its clients pay over $1 million a year to ServiceNow for like IT support, IT infrastructure, literally everything. But one of the things that they have is they've got a traditional software model as well, which is that they have on their income statement and on their balance sheet RPO, which stands for remaining performance obligations. So this is where effectively you've quoted for some software or something going into a business, and effectively you've got billing that's left over to yet be, earned, if you will. And they've got effectively 2 years of revenue already locked in. So this is a really interesting software business, growing super fast. They say that they're like the world's fastest growing. They define it some way. World's fastest growing CRM.
Growth 30% year over year in the public sector.
Yeah, it's. I can't remember the phrase. They kind of put this weird twist on. I'm not on the page right now, but I was researching it this week because of one of the positions that we're looking to take, and it's actually a phenomenal business. So over 5 years, it's up nearly 200%. It recently fell. This is why I started looking at it, from $1,100 a share earlier this year to $720 a share. So I was like, this is a 3-month turnaround on a super high quality technology company that's profitable, is growing wicked fast, has super fanatical base of customers like software developers, IT professionals, chief information officers, CTOs, those types of people.
So they
Fascinating
consult
business.
and they sell software, but they also consult to build and replace
Yes.
workflows. Yeah.
Yes. And so they've got this system which originally started with like IT service desks. So say, for example, when you would go, like you would, in your big corporate, you would request that like, hey, I need my IT something fixed. And effectively, like you would send this notification off to the IT team that might be 2 floors down and never receive your request.
Have you power cycled it?
Hey?
I used to say, have you power cycled?
Power cycle, I just turned it on and off.
Yep.
Yeah. But it's like, imagine that system, like, and how old and like archaic and cumbersome that system was. They effectively built their business on this model that you should actually just be able to like quickly and easily resolve those, have tickets and systems that allow you to solve those problems. The founder of ServiceNow actually came from a business where he had $40 million. Fred Luddy is his name off the top of my head. He had $40 million in this company that was in a similar business. He was the CTO. And it turned out to be a fraud. And he lost all of the money in virtually the blink of an eye. And then he thought, well, what am I going to do? I'll just go and start a business in my bedroom. And he went from he worked for him like by himself for the first few years, got some VC funding. Now the business has like over 30,000 employees. This is within like 10 years, Drew.
Yeah.
It's crazy.
Could be us.
Could be us, mate. We don't work from our bedrooms currently, but we could.
Close.
So we're basically on our way there.
Macquarie, I thought that was an interesting announcement from Macquarie Group too.
Go for it.
Getting rid of their public markets division. So all the big, the KKRs, the BlackRock stepping into private markets. Macquarie sold their global public market asset management division, public markets being bonds and equities, but they did keep their Australian business because it has more recognition here. Obviously, Macquarie's not as the silver donut, isn't as well known. And they still the silver donut overseas, but they sold it to, I think, one of the big Japanese conglomerates, Nomura, for $2.8 billion, and they had over close to $300 billion in assets under management. So they're saying it's another push towards focusing mainly on private markets, although they still got their Australian business here. I think share price reasonably well received.
Yeah, it jumped from 180 to 190 bucks. A share. It recently fell, Macquarie, from 240 odd bucks a share down to 170. So a massive retreat in the company's share price recently. It's a really interesting move, isn't it, to double down on private markets, particularly when the Australian business is so public facing in multiple ways, in particular with they've got their platforms for financial advisors, for wealth management professionals. They've got their home lending. They've got their banking, which I know you're with them. All of those things that are still ticking over. And to remove that kind of public markets facing funds business, it's a big move.
It is a story about ETFs as well. I know there are a couple of, we just saw Graham Tuckwell, there's an announcement about that today as well. But every week there seems to be like 3 or 4 new ETFs launching on the market. And they're all at a lower cost than the traditional active funds, whether they're active ETFs or not. And it kind of seems to be the story of big fund managers knowing that there's going to be fee compression and there's going to be more competitive pressure. And the flows have consistently been out of funds and active management into passive. So it wouldn't surprise me if it's that. Like, you're seeing fee compression anyway, so why not get out and allocate those resources to somewhere where you can still charge 2.20.
Yeah, bloody oath. It's interesting that this AFR article, I hadn't seen this until you just mentioned it. So it's been 2.5 years since Graham Tuckwell sold his business ETF Securities to Korean giant Murray, which, for those that don't know, Murray own GlobalX. GlobalX is a sponsor of this podcast. Now the exchange-traded fund Pioneers back with another ETF venture backing a new provider run by his son, David Tuckwell, and former GlobalX head of portfolio management, Cliff Mann. So David's appeared on the show before.
I thought Cliff got up as well.
No, never Cliff. So this is quite interesting. So you think that, is it a race to the bottom in ETFs, Drew?
Yeah, I think they just said they're coming in with a quality. was it equality of value and a broad global, and they're all going to be 29 basis points. So even a low cost, I mean, they're usually rules based in these ETFs. I'm not sure about those at 29 basis points, but even a cheap active manager with discounts is like 0.6 or 0.7. So I think replacing, as you know, we always see some use for some active management, not full actively managed portfolios, but there's more and more options for that core, and the core is increasingly, garnering like 50% of most portfolios. So it's just adding more and more competition to an already competitive sector.
Yeah, I think, the business is called ETF shares. No, it is legit.
I know it is. It's like, all right, what do we do? ETFs on share market? Let's call it ETF shares. Like,
I love a simple little name
what
like
was the
that.
first one called? ETF securities. But in the end investor knows shares better than they know securities. So I think that, it's like
makes sense. In other news, Satire is
hopefully I didn't pay a design for that.
Not good. Satire down more this year.
25%.
Once everyone realized that, as I wrote on the weekend, Drew, that China makes the products for Europe, who then sells them back to Chinese tourists. But years ago, Satire tried to convince everyone that only about 3 or 4% of sales were from made in China products. So I don't know.
You're probably getting a please explain from Bernard Arnault this week, I'd suggest.
Oh, well, yeah.
Telling everyone to go direct to China to buy their Louis Vuitton goods.
I mean, overpriced consumerism is a real thing in society. But, there are some brands that are worth paying for, but don't be fooled to think that any of those things would actually be made where they say they are necessarily. Like, you'd want to double check that for sure. I mean, we can assume R.M. Williams are made in Australia. I think that's safe to say, or a Kubra. But I don't know how many other things would legitimately say they're made in Australia. So
not many.
I think that rule goes for everything, to be honest. So, Satire's probably got I saw on Twitter, I won't go too deep into this, but I saw on Twitter that potentially it was the greatest founder exit of all time. It could be said. But in other news, let's get into some questions. We do have quite a few questions being sent in, and if you do send in your question, we would absolutely love a bit of banter on the way through, because it keeps us alive and happy, and everyone benefits from it. But we don't know your needs, goals, or objectives, which is one of the reasons why we asked for a funny name. So it helps us remind you that we can't give you personal advice through a podcast. No podcast can do that. It's really important you understand that, because before you go and act on the information that you hear on a Rask podcast, you should seek out financial advice, or at the very least, before you invest in something, before you switch to a different type of financial product like insurance or anything super fun, please make sure you read the product disclosure statement or PDS that will be available on the provider's website. If Drew and I have some sort of interest or shareholding or something in anything that we mention, we'll do our best to disclose that as we go through. The first question comes from Ben W. the 8th. And it says, "Hi guys, I want to buy some Nike shares, but from my understanding, I would have to fill out a W8 Ben form. Due to this, I've avoided buying individual international shares because it seems confusing and I don't want to get it wrong. I'm wondering at what point do I need to fill in this form and where do I find it? Thanks in advance. Love listening to the pod." You're very welcome, Ben the 8th. So the W8 Ben form is a form that you can fill in, and it goes to the US government. And effectively, it stops you paying 30% withholding tax. Instead, you only pay 15% withholding tax. And so if you don't fill out the form, you can still buy Nike shares or any shares for anyone that's listening to this generally. You'll have more withholding tax charged by your US broker. Most good brokers here in Australia, like CommSec, Pearl, or these types of platforms, have a guide on their website, or even allow you to do it digitally, and then they put it onto the paperwork that gets sent to the US government. My understanding is it does expire though, so you do want to keep on top of that. The CommSec team a few years ago were very helpful for me when they they reminded me that it had expired and I had withholding tax and I should fill it in. And I got a couple of grand back, which was really nice. But most brokers allow you to do US trading now. And it's just really up to you how you go about it. Drew, do you own US shares directly?
I do it through a platform. So I use one of the advisor platforms to do it. What you don't want is a W8 Ben E form.
Yes.
So W8 Ben forms, you usually have to sign them off before you're allowed to trade on those stocks. I wouldn't be something I'd be worried about. I think it's like if you invest in ResMed or anything that's dual listed, a CDI, then you're actually completing one as well. But it does get more difficult because the US government doesn't understand a family trust or a self-managed super fund. So the W8 Ben E form is about 14 pages long. And you can get that very wrong when you go through it. I'm always wary, like if you're going to do this, are you just buying one stock because you think it's fallen a heap? Or if you plan on setting up a more diversified group of US holdings? I'm always wary, don't go through all this work to just have one stock. Make sure it's part of your overriding strategy as well. But I wouldn't be scared of it. I think we did them all. I mean, my team does them all the time.
Sharpen your pencil, Drew. Come on.
I've done my fair share.
So I will ask you, I wrote about Nike on the weekend, which is maybe why people have started talking about it a little bit, but over or under, I don't own Nike shares, by the way. Nike, negative 20%, over or under, as it doesn't matter, or worse?
This year?
Over the last 12 months.
Worse. It sounds like 40, isn't it?
Yeah, 39% at the time of recording. Year to date, it is down 22%. 5-year chart, negative 35%.
On a 5-year chart, jeez.
But and that's us cycling off April 2020 lows.
Is that on Chinese sales? It feels like it's like sports and everything has rarely been more popular. Yeah, there's competition, but a lot of the competition's falling away as well. And shoes that maybe Adidas made that. Everyone's wearing the Sambas at the moment, so Adidas maybe making a comeback.
Adidas, which is a European company,
Adidas
is down to 7% for the year. It's actually up in the last month or so. Over 5 years, it's up 2%. But it actually is pretty compelling looking at the long-term chart of Adidas.
It does seem a quality business, and they do go through cyclical periods where they're out of favor. Expectations got too high. One of their markets doesn't, their fashion doesn't hit for a year or a quarter.
Yeah.
So I don't mind. I think it's a quality company.
Yeah. Adolf Dassler, who created Adidas, would be laughing about Nike's demise recently. Second question comes from Sam, believed to be their real fake name. ETFs. FANG. I think they've said AMZA, which maybe is Amazon.
No, it looks like a US listed infrastructure ETF.
Oh, okay. HAC and TPZ.
TPZ Tortoise. What does that mean?
These all look to have strong annual 5-year periods, and some may correlate but are different otherwise. It seems fairly straightforward for me to invest in these, or am I missing something? Accepting that these are high growth with higher risk.
Tortoise Capital Infrastructure Fund.
So we want to be pretty clear here that we're going to only speak generally on the show. ETFs like FANG that own 10 stocks like Amazon, Google, so on and so forth. And even HAC, which is the cybersecurity business, it's global cybersecurity, that's a bit more diversified. It's really important to understand that what you're getting and what you're not getting when you invest. A lot of people think that they are buying something, therefore that is the active decision that they make with their portfolio. So I go and buy a share, or I go and buy an ETF. So I am making that decision. When you do that, you're actually making two decisions. One decision is I'm buying FANG, therefore I'm getting 10 stocks. But that money has to come from somewhere. So if it was, for example, in the S&P 500, you're making a decision not only to buy 10 shares, you're making a decision to leave 490 behind. And people make this mistake very often. If they're buying individual shares, it's even more pronounced. People take an active bet, like fund managers all the time. They get absolutely crushed by the shares that they don't own. And so for me personally, there's basically two infrastructure funds, two tech funds, both heavily skewed to the US. We can't give personal advice, but just generally for me and the way we think about investing, that's too narrowly concentrated. and to one market as well, for that matter.
Yeah, these are and they do look like they're overseas listed as well. So I think I'd see these all as being satellites that sit within a portfolio. But then if I'm right on AMZA and TPZ, you can obtain very similar exposures investing directly in Australia. You could look at, there's actively managed funds. Magellan still has one, Clearbridge, Lazard, I think, in infrastructure. And then there's ETFs that you can actually buy in infrastructure as well on the ASX and also with hedging. So it's kind of like why you're overcomplicating it to invest in those overseas.
Yeah.
There's like, keep it simple, stupid. You shouldn't say the stupid part, but it is, always I'd be wary of what else you hold in your portfolio, because you are adding concentrated positions. And as much as Fang and Hack are actively managed, they're kind of backward looking, actively managed. They're adjusted based on another index. And that index makes big decisions, like Fang had Alibaba and Tencent. Now it doesn't.
Yeah. It's one of those things where you've got to be careful with, I guess, just being stuck in, well, I want this thing. Like the previous question, I wanted Nike shares, but why do you want Nike shares? That's just one thing. Is it worth going through all that hassle for that one thing? This actual next question, which comes from Kathy, holding NVIDIA was your one job, which I absolutely love. They say that Tesla's $2,600 price target is 5 years away and will always be. Discuss. So
I think I needed this year in my portfolio. So
well, Tesla, everyone will be pleased to know, for Drew's sake, is up 5% in after hours trade today. Came out with results. Elon Musk has said that he's going to be spending more time with Tesla and less time at the White House
with Doge.
What do you think, Drew?
I mean, I wasn't not a fan of Kathy, but these kind of like pie in the sky ideas, which may well be true, and maybe they had a share consolidation, so maybe it's already there. But it's a 10 bagger from here. I think Tesla, as I understand, has a great software and hardware platform, but a lot of competition has come in, and I reckon this trade war, as well as things that you're seeing in the car industry globally, that I think there is a bit of pullback on emissions, I believe, and restrictions. So I think I'd never predict a 10 bagger, really. I don't want a 10 bagger. If this thing goes up 10% on average, so if it becomes a 100% return and it doubles in the next 10 years, I'd be more than happy with that.
Yeah. Well, why not?
Or doubles this year would also be fantastic.
I can see a red hat. We'll come back to that. I can see Elon Musk standing with a red hat on, and it says Trump was right about everything on it. I mean, yeah. And then Dan Ives, who's this really respected analyst, covers all the big tech stocks in the US. He says, here's a quote in the ABC from Mr. Ives. It says, BYD has been a major force, but it speaks more to why Musk needs to re-engage with Tesla. There's huge competition, but also opportunity for Tesla. We've spoken about this a lot lately. And if we, for anyone that's watching, and we'll talk you through it if you're listening, we'll bring up the portfolios and the bit of the running $10,000 portfolio's that we've been having since the beginning of the week. I think you have had a pretty good week. Like I think Dizzy Rascals coming through with the goods. Only down 5.88% this year, according to the Navexa scorecard. And it is KKR.
Kev Tui.
KKR is plumbing new lows, down 29.6% for the community portfolio. Vulcan has come back to be down only 13%.
So I'll take that.
Yeah, it's not bad, says the community portfolio. This is the best one, which is mine. Down 9.5%. GGUS has been painful recently, I think it's fair to say, Drew. GGUS down 27%. XRF Scientific, which is a small cap. Remember that my portfolio was equally weighted. So my portfolio was 10% in every stock. We're allowed to pick 10 positions, and I picked 10. And I put them all equally weighted. XRF is the smallest company on my list. It's down 21%. It came out recently with slower than expected sales, and there you have it. But honestly, it's all about GGUS, ride or die, basically. So if the US market comes back, GGUS, which is twice leveraged the US market, watch this on the finish line. When it gets to the home straight, this is like DRS. It
Santa
is
Claus
just
rally.
straight through. Santa Claus rally, bring it on for the United States. Finally, over to the everything portfolio by the Honourable Andrew Derrimouth, down 11.5%, coming in at third place. NVIDIA weighing on the portfolio down 26%
Not a single winner.
The mighty Tesla down 39.6%. You can pick it up cheap, says Drew. And if
Wait,
that
how is
goes,
the total return more than their currency? Right. Yep.
so
Nothing
Tesla,
to see here.
if Kathy is right, it's going to be a 10x for you from here, Drew.
Hopefully
Tesla
within
is currently
8 months.
$250 a stock. So, yeah, we've got 8 months to get Tesla to Kathy's price target of 2,500. What would it have to take to get Tesla, which is an $800 billion company at the time of recording, to become a $2,500 stock? Yeah, what would have to happen, Drew?
I would have to go into semiconductor chip production. It would have to be the most sold car globally, I'd suggest, or it would have to have its software adopted in other cars. It wouldn't surprise me if something like that happened. Charging stations, maybe SpaceX rolls in. I'm watching probably one of the best shows I've ever watched at the moment too. Maybe that's where Tesla comes in. All for All Mankind. It is actually, I was very surprised about how good it is. It's about if the space race never slowed, if Russia beat us to the moon and the space race never showed. Maybe that's where it comes from. They roll SpaceX in and we start colonizing the moon or colonizing Mars, not to ruin the story of that. But and this is what I think you've probably spoken about with Nick Griffin before and a few of those other visionary types where they saw Amazon initially as a book company, but they actually saw what it could become once it got that market running. They saw, Microsoft was an operating system, and then you realized it was actually going to control everything. And some people got that really early. Apple, and there's always multiple false starts. So maybe this is one of Tesla's false starts.
Maybe no, I agree. I'll come back to that. For All Mankind, I started that show quite a while ago. It's actually very cool. Interestingly, all sales of Tesla during the first quarter of 2025 up 4%. So Tesla Model 3/Y, which is their core mass market, number in production was 4%, and deliveries 323,800 Model 3/Y Teslas. So it's clear that we've spoken about this before, that in the European market, Tesla is falling way behind. The zeitgeist, if we just put it down to the zeitgeist, which is just that people are turning away from Tesla for brand reasons. I think it's fair to say. I'm thinking if everyone's turning away from it, I should buy more. I don't own the shares, but I might buy another Tesla. I think
put that into shares and you might do all right.
Maybe do all right. I think in order for Tesla to reach $2,500 a share, which is a 10x by the end of the year, basically BYD would have to somehow vanish overnight.
Yeah.
It would just have to vanish, but it's not going to happen. So have a guess. Can you tell me someone who invested in BYD, Drew? Big investor bought BYD.
Mayoshi-san.
Maybe, I don't know. Probably. Charlie Munger.
Really?
Yeah.
Yeah.
Yeah. Through Berkshire. They were one of the big early investors in BYD.
SoftBank surely went in there too.
They do everything.
They got a bit of everything. They had WeWork, so.
Yeah. Yeah. $100 billion company. So BYD, just for people that are playing along at home, in 5 years, the stock is up 500%. It's gone from $58 to $365. Chinese yuan, it's got $1 trillion market cap. I'm not going to even try and convert that because I have no idea what that means. So it's just a number. So next we have, what do we got here? Maybe we can go with, this is a good financial planning question. This comes from Lady Cashanova. At 50, fresh from a divorce settlement and with cash in hand from selling the family home, what's the smartest move? Buy a home for yourself and your 3 grown teens? Rent while investing, dive into real estate, or play the stock market? It's time to strategize, they say. So Drew, not to give personal advice, just you've probably seen this before. People go through divorces, people go through big life changes, widows, that sort of stuff, big, large lump sum payouts. Where do you start pulling that apart?
I think so much of this has to be personal. Like there is this kind of, whether it's peer pressure or whatever it happens to be, and the feeling of security that comes with owning a home. But I've actually been watching, there's another financial advisor called Rebecca Pritchard. I'm not sure if you've met Rebecca before.
Yep.
Yeah, she's actually posting on LinkedIn a lot about this at the moment. I think she specializes in helping women in this situation, or advising women, not helping women. And it is that you don't jump into things and don't feel the pressure to do it straight away. It's more like, how do you, if you think that'll find stability, well, most of the time it's going to add to a mortgage and then going to put more pressure on. And like, how do you take your time? How do you settle, and how do you find routine again? And what do you personally want, which can be very difficult to have the space to think about. So I think it's more pause. Like there's nothing wrong with renting for a period of time, pausing, thinking about it, looking at what the next, at 50, what the next 15, 20 years holds, before you jump into anything. Do you still want to live in the same area? What's going to happen when the kids finish school? Do you still want to be, if they're in their teens, you still want to be in this? This is getting very probably specific and personal, but I think the big thing is don't rush into anything and try to take the time to reflect and think about the bigger questions, as opposed to feeling like you have to be in the market. And I'm always like, and without that idea, it's also questionable whether you should go in the stock market. You should definitely be putting your money to work in some way, but I think you got to make that big decision first and then build a framework around it. That's why advice can be incredibly valuable at this period.
Definitely. Around any of those major life events.
Yeah.
Some people do it when they're just got married, having kids, buying a house. Others do it when they've gone through something like this, big workplace injury, accident, death in the family, inheritance, and then, of course, retirement. There's so many different reasons that you seek out advice, but it's typically those big catalysts. And the reason that you get advice is that it gives you clarity of the goals, and then you can use the financial knowledge to support that goal. Final question for today comes from Jazz the Boxer. In brackets, my dog.
My dog.
No prizes for guessing her breed. What do you reckon
French
it would
Bulldog.
be? Yes.
French Bulldog.
I was going to say Groodle.
Boston Terrier.
Question is, could you please cover Vanguard's two new diversified ready-made ETFs, Vidal and Vidif? So Vidal is the Vanguard diversified all growth. So these are like kind of quote unquote ready-made, diversified. The one's focused on income, and it's really just a bunch of Vanguard funds pulled together, fees around about 0.32% per year, which is a pretty good out-of-the-box type of thing, in my opinion. Keeping in mind that Vanguard has always had VDHG, VDBA, VDCO, these types of things. The question goes on to say, I currently hold 1/3 VDHG, 1/3 VHY, and 1/3 consumer non-cyclical companies like Woolies, Coles, Metcash, Endeavour, and IXI. I consider this as one group, my own ETF, as it were. And I have a satellite. This is an interesting satellite, Drew. SGLLV, Sunrise.
Sunrise, the rice producer?
I think so. I don't know another Sunrise. Do you?
No.
They say, love the show, Wu-Tang. So, yeah, Sunrise is Rice Growers Limited. And it's Sunrise. I don't think anyone in the history of any RAS podcast ever, over thousands of episodes, has ever mentioned Sunrise, which is Rice Growers Limited. It's on the ASX by the looks of this. And it is, I didn't even know this was an Australian company. I just assumed that this rice company would have to be from somewhere in Asia.
Yeah.
But
Japan.
there you go. It's a $700 million company. It's got a dividend yield of 5%. So let's just think about portfolio construction. Sunrise or?
No, Vidal.
Oh, okay. Why is that?
Just looking at it, it's like, are you paying a premium just to blend together other ETFs? You're just outsourcing an equity decision, and you're getting 2% in Vanguard Australian shares, you're getting 5% in Vanguard Emerging Markets, but you're getting 36% in VAS, and you're getting 22% in I can't remember, VGS. And it's kind of like, and the hedging decisions taken out of your control. I don't think they're like, it's not particularly bad, but if you think about the materiality of some of the other holdings in there, it's like you want to have your core, you may as well get the lowest cost core and spend a bit more of that 29 basis points, maybe adding some true active management in emerging markets or small companies to smooth that ride. Because your decision as to how much you have in US tech and how much you have in Australia is taken out of your hands.
That's the big thing that people have missed with all of these ready-made portfolios. There's really no flexibility at all. And people are fine with it when they got 20 grand, but if they've got 2 million when they retire, they're going to have a lot of issues. And I also, I was chatting to Gemma Mitchell, head of advice at Rask this morning about this. I think people have assumed wrongly that what happened in the past will happen in the future. Morgan Housel had this great tweet that he put out a while ago. I'll see if I can bring this up. Effectively, he said, I'll see if I've got this. Here it is. He said, the top 3 investing skills are as follows: patience, temperament, and having your career coincide with a 30-year uninterrupted decline in interest rates.
I've said that way. I wish I got all of that, but yeah.
Your career coincide with a 30-year uninterrupted decline in interest rates. Literally, everyone looks at index funds and they go, they've gone up over the last 30 years. Therefore, they will continue to go up in the next 30 years.
You're coming on the active management bandwagon.
No, we do have like active decisions, but I think that people are naive to assume that what happened in the past is going to happen in the future. We've spoken about this a lot. It's like
an index alone is going to be completely fine.
Yeah. We've spoken about this, like recency bias. People think like what happened in the past happens in the future. When people think about recency bias, they think about what's happened in the last day, week, month, year. But recency bias can also be over 30 years. Like there are exceptions to stock markets going up. The US is probably the exception to the upside over the past 30 years. But I had a conversation with Pete Wargent on the Australian Property Podcast yesterday. And he told me that he's been buying property. He's a kind of buy and never sell type guy. He's owned some FTSE index funds, so FTSE 100 being the UK stock market, since 1996. And I brought up a 25-year return of those index funds. They've done 6.6% per year. And it's only because the last couple of years have been really good to the UK. So 6.6% per year. Imagine if you locked in an index return, 6.6%. Now, Pete's dollar cost average, which is great. But a lot of people are anchoring towards 10, 11,
Everyone
12.
thinks you just automatically get 10. If you go on Instagram and look at a lot of the reels that come up, it's, if you compound at 10% every year, or you don't.
Yeah, exactly. And so I think that people should explore different strategies. And I think that not specific to this person that wrote in, but just generally is to be aware of the different strategies. I think that these diversified ETFs, not these ones specifically, but just in general, diversified ETFs are a fantastic solution for beginner investors and for people that are getting started. When they first came out at Rask, we made them our number 1 ETFs of the year because we thought these are fantastic for people that are just starting out. But as time goes on, it's important to build a portfolio around that, I think. You don't need to go crazy, but just have different things in the mix. Maybe you got your super invested at different ways of what you've got, stuff outside of super, your property, your cash. As you would always say, I think the thing that I always take away from catching up with you, Drew, is that that line that you've always said, which is don't prepare for a future, prepare for any.
Many.
Many. There you go.
Many.
I kind of, whatever. It's good. Good.
No, that's D12. D12, isn't it? Yeah, not Wu-Tang.
Yeah. But anyway, that was a great question from the listener for this week, who is going by the name of Jazz the Boxer. We had another great question from Lady Cashnova about divorce settlements and starting in. It's all about goals. Kathy, holding NVIDIA was your one job. Tesla may reach $2,500 this year, says Andrew Dermuth. Sam says he had the portfolio, shared the portfolio of almost all tech, all infrastructure. Just remember, and Ben the 8th also had a similar question about investing in the United States. Remember, you don't need to invest in the United States. A lot of, directly, a lot of Australian investors go to their brokerage account and they all talk about investing on Wall Street and having US functionality and all that sort of stuff. I couldn't tell you the last time I actually logged into one of those and actually bought the stocks. ETFs do a fantastic job. Lots of Australian companies, lots of Australian vehicles, so get around that. If you want to catch up with Drew Meredith from Waddle Partners, you can do that on the Waddle Partners website or follow the link in your podcast player. Drew, you've got to leave us with a dad joke.
This one could be a bit risque. Could be a bit risque.
Okay, before you get to that, everyone who wrote in today gets a free copy of the Value Investor Program on Rask Education. It is a free, it's not free, but for you it is. If you wrote in, just let us know and we will give you a coupon code to go and use on the course. It's my complete curriculum to help you invest better, whether it's in shares or ETFs. It covers everything. Drew, what's your joke?
Why was the sand wet?
Joe?
Because the seaweed.
Very risky indeed, my friend. Dad joke. That's actually a pretty darn good dad joke. Yeah. That's good. Try that on the kids this weekend, mate. That's
we're doing one about cemeteries at the moment in the car. That's pretty funny.
Oh, that's a good one. Do you know it off the top of your head, or are you going to save it for next week?
Yeah, it's a bit dark. I think. And it's like a double act as well. So my partner says, "Oh, we're in the dead center of town," which is always when you go past the cemetery in front of the kids. And then the response is, "Yeah, people are dying to get in." So it's a double act, and you always get the oh. Well, mate, they'll turn around. They'll have it soon. Don't worry.
Everyone that's a regular listener of the Australian Investors Podcast would be so envious of your kids being able to be stuck in your Toyota Prado, just listening to your dad jokes continuously ad nauseum, mate. Well, this has been heaps of fun.
We're going to do an episode from the Prado, or we're going to drive out to Meredith Dairy. So anyone listening from Meredith Dairy, if you have the facilities for us to do a live episode, I think it would be a great idea.
Yeah, anyone that knows the goat's cheese,
like me, obviously,
yes.
Don't reach out to me. Yeah. I'm not an heir of the Meredith goat's cheese.
But we would love to do an episode on set. So let us know. Drew Meredith, absolute pleasure. Thanks for joining me.
Good to see you.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.